Hi, everyone. Hope you're well, and welcome back to another video podcast as part of the Edge Capital podcast series. Today, I'm joined by Alex and Dmitrii from our Vaults team. And today, we'll be diving into some of the most important structural topics in DeFi right now, particularly around transparency, collateral risk, and risk management in leverage strategies. For those unfamiliar, Edge Capital is a $500 million investment manager focused exclusively on CeFi and DeFi trading strategies and a large player as a risk curator on many vaults. So let's dive into the questions today around transparency and vault ratings. Obviously, we've seen a huge demand in transparency and independent vault ratings following some recent market events over the last couple of months. What is driving this shift, and how should investors think about evaluating vaults risk today?
Sure. It's a very interesting question, and it's fueled by the recent market events that unfortunately made everyone realize that not all the yields in DeFi and the vaults in particular are safe. Like, everyone assumed that you can just simply print 10, 20, 30% APY without assuming any risk and without the possibility to lose your funds. But unfortunately, first of all, during the events of the 10th of October, when the huge liquidations happened, and then the situation that unfolded in November around stream finance and all the vaults and markets where it was present and where it was used as collateral, it showed that actually some of the investments and some of the collaterals that are used in DeFi can potentially be on the risky side, and they can lose their value significantly. So that's why we've seen a huge surge in the interest towards the transparency around the curated vaults and the collaterals that are used in lendings. We see that many people try to converge to different solutions. So some of them try to use tools like Accountable that allow you to self-report the funds that you are managing, or even show the positions that you might have on centralized exchanges and not only on chain. The others are thinking of transparency through working with third parties, and this is actually the route that we are leaning towards, because we, as a company that was born out of Edge Capital, which is the regulated hedge fund, and have experience working with a fund administrator who is constantly checking the transactions that are done by the team to ensure that none of the funds can leave the contour of the fund. So we're thinking that maybe it's an interesting approach to try and incorporate such an approach of dealing with an external fund administrator in the vaults as well, because this would bring the highest level of transparency and trust towards the vaults that you can get.
Brilliant. Thanks so much for the insight, Alex. So moving on to lending vaults and collateral risks. And when it comes to lending vaults, where do you see the biggest hidden risks, particularly around collateral quality, liquidation mechanics, and perhaps counterparty exposure?
I would say that this is probably something that Dmitrii can answer better than me, but I will just start leading with the fact that not always all the collaterals are and all the lending markets are using market oracles. So it might mean that the exchange rate where you try to price the assets toward the little underlying, like a blue chip, for example, can be a fixed rate oracle. It would mean that even though the collateral itself might trade in the market at a much low value than the smart contract returns the price to be, in the end, there's no automated way to liquidate such a position. So Dmitrii can probably explain a little bit better how it all works. So
yeah, sure.
Over to you.
Thanks for your insight. When we're talking about lending vaults, from first glance, it looks like something much simpler compared to actively managed tokenized funds. But effectively, when we are talking about lending vaults, about lending curation on such lending venues as Morpho, Euler, Gearbox, where we UltraYield have our own vaults and actively developing our vaults, lending vaults and collaterals here. You should employ a really thorough approach in terms of estimating collateral. You should employ due diligence in terms of you should understand precisely what this particular collateral doing, whether it is your C4626 asset or it's like some plain blue chip, which is quite safe on one hand, but anyway, you should always be aware of some spiral risk, of some like correlated risks in your vault, and you should estimate configuration and other aspects of your collateral accordingly. When we're talking about adding up collateral, it doesn't matter like whether we have an isolated wall markets or it's like some composition of various collaterals. We should be always checking like when we're making the configurations, the crucial parts for lending vaults is supply caps, interest rate model configuration, like interest limitations in terms of like if we can configure it somehow, especially for a particular collateral. And of course, in terms of collaterals, it might be some HC4626 token. It might be some blue chip, it might even RWA, which you should, LTV, which you choose for those assets should be much lower because you should be aware of underlying risks, liquidity, and some other parameters.
Great, fantastic. No, thanks for the insights. And I think a popular theme that we've been seeing, and obviously you guys have probably been seeing, is tokenizing funds as collateral. What are the benefits and where do the risks start to emerge compared to traditional on-chain collateral?
I think when we like tokenized funds is on one hand the product which allows like to generate the most efficient yield, I would say on one hand, but on another the amount of risk which lays beneath this token might be insanely higher, and for these purposes, like you as a curator, as a strategy provider, you should be very, very careful with it. You should be aware that there is a reliable proof of reserve. As Alexander mentioned before, it is the best scenario here if this proof of reserve is provided by institutional grade manager or company which directly specialized on reconciliation, on NAV, on some other topics, on some other business, I would say. And yeah, in general, as a curator, you should be very careful. You should precisely estimate your risks. And even in some cases, you might create some isolated liquidity venue for users who want to add your liquidity here. They can, you're giving them opportunity to understand the risks. It's not like, so they understand that their risk is isolated. It's not like a basket. But if you're talking about tokenized funds, it might be one of the best approach here to limit the risks for external users.
Alex, that said, but that said, actually, like if you think about it from different angle, this is also a good thing because it's a diversified portfolio. So in the end, like if you trust the manager, if you are certain that there is no fraud involved, then it might be a good asset to deal with. But at the same time, like you have to do a really proper due diligence, and this is what we are trying to do. For example, like lately when we've been setting up a gearbox market on Monads, we've been talking extensively to all the managers of different assets that are present on chain, and we just need to be sure that the team behind the project is a reliable one. Then, of course, we try to get the proof of reserves and all the other necessary materials to be on the safe side, and only then list the collateral in our markets.
Perfect. Makes sense. Thank you so much for the insight. And obviously, 2025 has been no exception. Extremely volatile year in crypto, as you mentioned. Liquidation events at 10:10. What are the most critical elements of risk management when running levered positions, especially across volatile or fragmented liquidity environments?
So once again, Dmitrii's area of expertise.
Yeah, sure. It's comprehensive question, I would say, because it really depends on the platform, some technical aspects of the leveraging. So usually our approach here is that we do, again, a really thorough due diligence of the underlying assets on the platform in particular, because we have to understand all the critical points here, like how Oracle is computed, for example, as Alex mentioned before, whether it is some secondary market reference or price feed is taken directly from the contract, or some a combination of like contracts. And in this scenario, we can define leverage. Like in one scenario, if assets are correlated between each other, we can set one health ratio. If you understand that the source for the price is not a secondary market, which might be volatile, but it's a contract, we might use more tightened leverage, effectively increasing our yield in this particular trade, and fully understanding the risk that our trade is quite protective in terms of external fluctuation volatility. Also, when we're talking about leverage, this is the thing, of course, which allows you to increase your yield significantly, but you should understand liquidity constraints if you create this leverage position, whether you are able to briefly close this position without any execution costs and make it smoothly for users. Of course, we are talking about some actively managed vaults when all the execution costs are laid beneath your price updates. So you should understand execution costs, you should understand Oracle. Of course, we are checking historical data if you're talking about correlated assets. And the most important part here is the effective LTV. You can have one for correlated assets. For uncorrelated assets, you should understand, and we usually simulate data all based on historical time series, even including 10th October when the price drop was increasingly significant. And even including this price drop, we are calculating safe health ratio, safe LTV level, and based on that, we're keeping our leveraged position. And if we are talking about some products like actively managed vaults, of course, we are keeping some liquidity buffer. So in case if we anticipate some market movement, we can replenish this buffer, replenish our lending position, and keep users' funds on the safe side.
Brilliant. Thank you so much for the insight.
I might have missed one point. Did you talk about like the speed at which you can exit the leverage position? Because it might be a significant issue as well.
Yeah, sure, mention that. Of course, it's more actual when we're referring to some EVE-denominated loops. And yeah, it's like essential to understand that you might make position, but time to exit it might be like a few months, and you might see a huge liquidity constraint in this case.
Brilliant. Thanks for the insights. And just to wrap up, I know you guys have touched upon this, in an earlier call in certain parts, but for sophisticated investors out there, what does the robust due diligence process look like for lending and actively managed vaults? What are the red flags they should look for? What are the green flags that are positive signs? Just to sort of briefly summarize this video and the points that you mentioned earlier.
Yeah, sure. Generally, even if you're talking about lending markets, our due diligence process is thorough. We are looking in depth into every collateral assets. And we have our own risk framework where we see like business aspects, technical. We even look into team's background, if you're talking of ERC 4626 assets, some tokenized funds, and some other parts. We even look into like legal side of the question. We, in some cases, can pay for external auditors for additional smart contract due diligence to understand that everything is audited, that we can rely on this asset, and we can add it as a collateral to our lending market.
Fantastic. Well, I think we'll probably wrap up the video here. Dmitrii, Alex, thank you so much for your insights. And to all those watching, just a disclaimer, obviously nothing in this video is financial advice, and we recommend you to do your own research accordingly. Thank you so much for tuning in. Have a wonderful rest of 2025 and looking forward to speaking to you all again in 2026. Thank you. Take care. Bye.
Thank you.
Thank you so much.